Friday, October 28th, 2016, Maneco 64, home of alternative economics and contrarian views. So I like to talk about the bond markets. And why are the bond markets important? Because they set interest rates. Interest rates are derived from bond prices. When bond prices go up, interest rates go down, and vice versa. And we've had a bull market in bond prices since 1981, when the 10-year U.S. interest rates, 10-year note interest rate, was around 15%. And recently we had a low, all-time low in the U.S. 10-year yield of around 1.32%. That was back in the beginning of July this year. And I even made a video saying a few weeks later saying, is the 35-year bond bull market over? I've made other videos early this year. One of them asked if the Fed and central banks were inducing a bond bubble, that would decimate the financial system. And why do I say that? Well, because all other assets are priced off government bond interest rates, especially the U.S. Treasury interest rates, because they're considered the risk-free rate of return. So stocks, corporate bonds, everything is priced off those interest rates. If those interest rates are going down like they have been since 1981, financial assets go up in price because they discount the prices at lower interest rates. That makes the price higher. But a bull market can only last that long. And recently, beginning of October and end of September, we've seen a bit of activity that has been weird in the bond market, mainly because we've been seeing stocks go down and bonds go down as well. And that usually doesn't happen, hasn't happened the last 15 to 20 years. There's also been warnings because investors, speculators, pension funds, they've been forced to buy bonds further and further out. And by that I mean they've been forced to buy bonds that mature in like 30, even 50 years. I saw I think Austria issued a 7-year bond. They've been forced to buy these longer term bonds because their yields are usually higher than the short-term bonds, and the short-term yields have gone to zero or negative in some cases. So now they're trying to get this yield, and what that has done, it's driven even the long-term bonds to all-time lows. But the problem with that is when the risk of holding long-term bonds is a lot bigger than short-term bonds, because someone can go bankrupt. There's a good chance that the Austrian government could go bankrupt within the next 7 years, but there's a small chance that it could go bankrupt in the next 2 years. So what that means is that the risk and the volatility, which is called duration, of the whole bond market has increased massively. And there's also a lot of leverage in the bond market. And there's not only investors buying these bonds, underlying bonds, they're buying futures, OTC derivatives. I used to work in the bond futures market. I was a broker for over 20 years. My clients were banks, institutional investors, hedge funds, mutual funds, traders. And I know about the bond futures market, and it's highly leveraged. For example, right now, you can put down $5,000 and control 129,000 worth of 10-year note futures. So you can leverage yourself 30 to 1. So Ray Dalio, who is the founder of Bridgewater Associates, it's an investment firm that manages $160 billion. He warned in the beginning of October, and Zero Hedge caught on to that, and it says, the article, Ray Dalio warns a 1% rise in yields would lead to trillions in losses. So this is a guy who founded this firm. They manage $160 billion. He's worth $15.9 billion. So he knows what he's talking about. And I've made videos talking about the same things that he's talking about. Of course, I'm not worth billions, but basically warning that a turnaround in the bond market could be very, very dangerous for the system. And are central bankers losing control of interest rates? We thought they wanted to keep interest rates low. Maybe they're admitting that we actually need higher interest rates in order to increase inflation expectations. And you might laugh when I say that they want to increase inflation expectations because we know the cost of living has been going up. But for them, actually, believe it or not, they're trying to reach their 2% target, and they haven't been successful with all the QE and all the money printing, all the zero interest rates. Inflation hasn't gone up. So maybe they're changing tack and allowing interest rates to go up so that investors actually begin discounting for higher inflation. The problem with that, though, as Ray Dalio said, is that the bond market has been so inflated into such a big bubble that they might not be able to control this rise in interest rates. We could see a complete loss of control, and that's very dangerous for the financial system. We haven't seen that yet. I'm going to show you a few charts here because I don't want to be a scaremonger. So we look at the 1 year, 5 year chart in the UK gilt yield, and the high in 2014 in yield was 3.02%. We dropped to 0.5% in the beginning of August. That was the all-time low there. And now we're at 1.25. We did get up to 130 this morning. So yeah, it's early days yet, as you can see in the chart. But if we keep going higher like this and it accelerates, we need to be careful. So let's look at the U.S., the 1 year, the 5 year chart as well. As you can see, we were a lot higher in yields into the beginning of 2014. We got to 3% there as well, and it's been dropping, and we reached the low in the beginning of July of around 132, 135, and now we are at 186. So it has been, since the summer, yields have been spiking higher. But as you can see, I think we could reach 2% very quickly. But when we have to start worrying about it is if we go up above 2.5% and then 3%, if that happens in the next 3 to 6 months, then we have to start worrying about it. But just wanted to point out that we have bottomed in these yields. So for example, in the UK, the 10-year yield reached 0.518%, basically 0.5%, on the 12th of August. And right now, we're basically around 130. So that has more than doubled. We reach 1.5%, that's going to be triple in interest rates. The 30-year yield in the UK has gone from 1.22, we're now around 190. That hasn't doubled, but it could very easily double. We could very easily be at 2.5% before the end of the year. And for the US, for example, the 10-year yield is up 30 basis points in the last month. So from 156 to 186. That's a pretty hefty move, and the 30-year yield is up 33 basis points to 262. So why is that a problem? Well, as I said, all financial assets are priced off the risk-free rate of return for government bonds. The U.S. Government bond market is the benchmark for interest rates around the world. And stock markets are also very sensitive to interest rates. So not trying to scare people, just keeping people aware of what's going on in the bond market. So this morning, it's just gone past 9 o'clock London, or 4 a.m. Eastern Standard Time in the U.S. Gold is 1267.50, so down half a dollar, basically unchanged. The Dow Jones Industrial Average is down 50 points at 18,120. Silver is 1763, basically unchanged. The currency is a little stronger, not that much. And I'll have a look here at something I used to trade. It's the 10-year note future, the December contract, which is the front month right now. It's trading at 129 and a third. We got down to 129.20 in terms of decimal, because actually the US futures are traded in 30 seconds, not decimals, but I've got a decimal quotation here. So yeah, bond markets are down, but they have recovered from the lows, but we need to keep an eye on them. So, and I'll put links above in the cards for my previous videos explaining the bond markets. There's a lot that I haven't talked about here, but you can catch up on it through my older videos. So if you enjoyed this video, please give me a thumbs up below in the near the description. Share it with friends, families, colleagues, whoever you think might be interested in it. And subscribe to my channel as well if you haven't yet. And if you'd like to donate to my channel, there's some links below in the description. I'll talk to you later. Bye.